Hello, I'm Ryan Schrift, and this is Thoughts from the Vault. 2021 proposed tax changes. I have them here in front of me. By now, you should have seen that the House Ways and Means Committee has released a draft of some major tax legislation. So we've all been talking about this for years during the election. What campaign promises from the Biden administration actually translates into law, and what that looks like for us as individuals. So this isn't about business taxes, this is about individual taxes. And so I want to give you a couple key points, at least the best of what we can glean at present time. So first of all, single filers with income below $400,000, joint filers below $450,000, you're probably not going to see a significant impact at least right away. Now, taxpayers with incomes over those thresholds will. What we're looking at is, the marginal tax bracket for ordinary income going back up to 39.6%, which would be an increase. Also, especially from an investment standpoint, capital gains taxes could go up from 20 to 25%. 25% is not great, not excited about it, but it is better than what some folks were talking about, taking it all the way up to 39.6. So for those higher income earners, you're looking at going up to that 39.6% ordinary income rate and 25% on capital gains. Now, this will impact everybody. If you've ever heard of making a non-deductible IRA contribution, then rolling it over to a Roth, it's called a backdoor Roth. It looks like starting out in 2022, that's going to go away. The same with the mega backdoor Roth. Even elimination of all Roth conversions are going to go away, probably for those higher earners, but not until 2031. So there is still some time to do Roth conversion planning over the next decade. Probably the bigger news here is if the gift and estate tax exemption amounts get cut in half. We're looking at taking that to $5 million per person. It's over $11 million now. But if it does go to a $5 million, that'll impact a lot more folks. And I know $5 million is a lot of money. But what I would mention to you is by the time you add up, 401ks and homes and investment accounts and all those assets, any life insurance would also count towards that estate. And so if you have these large term life insurance policies or whole life insurance policies, you may want to consider how those are titled if or when this tax change takes place. Finally, they're looking at doing a 3% surcharge on high income folks, but that's also going to apply to trust. And so, it might be more controllable under a trust to not generate more than $100,000 a year, unless you left an IRA to a trust, in which case that 10-year requirement to deplete an IRA for inherited IRAs could certainly accelerate that process, forcing you to take out more than $100,000 and hence pay that 3% surcharge. Taxes are taxes. It's going to be what the government decides. Ultimately, you can do tax planning. You can think ahead. You can know what you're doing. And certainly, if there's anything we can help you with here at our office, please give us a call. We're just looking for better client outcomes. Thank you.